Tom Lee of Fundstrat just made a major statement about the stock market, saying this could become a generational bull market driven by the explosive growth of artificial intelligence. He also believes there is still a strong risk-reward balance in equities, even after this massive rally in AI and tech stocks. In this video, I'm going to show you the clip of Tom Lee speaking on CNBC, and after that, I'll break down exactly what he meant, give you my own reaction to his comments, and explain why Wall Street is becoming increasingly bullish on the AI trade. Then later in the video, I'll give you my in-depth analysis of 3 solid tech stocks that could be positioned to benefit the most from this AI-driven market boom. Let's hear what Tom Lee had to say.
He's Fundstrat's head of research, a CNBC contributor. Has been all over this move on the right side of it. Welcome back. It's good to have you. You know, what's interesting to me is you say that the risk reward in the market is still positive. I'm wondering, though, whether that spread is starting to narrow.
Hi, good afternoon, Scott. To us, stocks are rising for the right reasons. I know I've said that before because we've had good earnings, but also just evidence of really the scarcity of compute and the supply chain, whether it's semis and energy, and AMD's the latest example. But the market hasn't made these stocks expensive yet. The forward PE of the semi index is still only 22 times, and while that might sound high because they were expensive, more expensive than a month ago, they had gotten as high as 35 times over the last 20 years. So to me, there's still pretty good risk reward, even in the stocks that are leading this rally.
So the risk reward is still fairly balanced, I hear you suggesting. Is that right?
Yes, and I think that there's still, there was so much skepticism as the war started and reached its crescendo that we do believe there's still a lot of money on the sidelines. And, in this case, I think it's actually more retail investors that are chasing this move, and that may explain why we're seeing such big moves in things like memory and semis.
You don't think that, sentiment or what's being reflected in the market by virtue of some of these moves has gotten a little bit too much? I bring up this note today from Ed Yardeni, obviously friend of the show. He's on frequently, is talking about to infinity and beyond. What he's calling now the Buzz Lightyear theory, BLT, of AI. The data revolution is going to infinity and beyond. He says he's even more bullish than his original Roaring 2020s scenario. Is that well-founded? Is it a point of concern? If you start getting some of the folks who are generally speaking pretty bullish to sound almost euphoric, is that something to worry about?
I think it's something we have to calibrate because I'm actually here at the Milken conference, and I think one of the recurring themes is that AI for the U.S. is probably adding 2 percentage points to GDP each year for the next 5 years. That's like 6% S&P earnings growth coming from AI productivity. And balancing that is, I know a lot of rational investors that continue to point to this coming shortage of petroleum products. So I think there's enough logical reasons for people to stay cautious, but I think there's now a fundamental argument for why AI is causing earnings growth without inflation. And so that is a good combination for stocks.
But see, I look at what you still suggest is a 3-phase market. That's how you characterize it. A rise of the S&P to 7,300, check, right? We're there, beyond it. But then you talk about headwinds emerging. See, as we started this year, to refresh everybody's memory, you thought we were going to have a really good start to the year. We would drift into a bear market before another upswing would take us even higher into the end of the year. Now, when the war broke out and we had about 10% or so pullback in the S&P, I thought, well, maybe that's Tom's moment. He couldn't get the timing right, because who can? But that was the pullback, and now we're so bulled up on AI that maybe we're going to do just fine for the rest of the year. But you're still looking for a drawdown of 15 to 20%. Is that right?
I am, Scott. I think that 7,300 originally was like an aspirational level, and now that we're here, I think that there still is fuel for a move higher from here. But we do have to confront later this year Two things, and maybe it won't affect the markets, but I think it's the trigger for a drawdown. One is, of course, the market will test a new Fed, and this incoming Fed chair has some different theories on the sources of inflation and how to read inflation, and so the market, I believe, will put those views to the test. And of course, the second is that every day that the strait is closed, we know that there's an acute shortage developing of petroleum products. So if price reacts later this year, that's going to test the market. So I do think there's the ingredients for turbulence later, but AI and the scarcity, and the U.S. is the provider of that scarcity, is why I think we can exit 77 or higher, and maybe 2027 is one of the biggest rallies we see in our lifetime. So I think it's still a bullish outlook, but turbulence in the middle.
The interviewer opens the conversation by questioning whether the risk versus reward setup in the stock market is starting to become less attractive after such a massive rally. That is the key issue everybody is debating right now. The S&P 500 keeps pushing to new highs, AI stocks continue exploding higher, and naturally investors are asking whether we are getting too euphoric. But Tom Lee immediately pushes back on the bubble narrative. He says stocks are actually rising for the right reasons. That part is important because he is making a distinction between speculative hype and fundamental growth. In his view, this rally is being driven by real earnings, real demand, and real shortages in the AI infrastructure supply chain. And honestly, when you look at companies involved in semiconductors, data centers, memory chips, and power infrastructure, it is hard to completely dismiss his argument. The AI boom is not just some vague futuristic idea anymore. Companies are spending enormous amounts of money right now to build AI capacity. We are talking about billions being poured into GPUs, cloud infrastructure, advanced chips, energy grids, and data centers. That money is flowing through the system already. Tom Lee specifically mentions AMD as one of the latest examples proving this demand story. That stood out to me because AMD's earnings recently shocked a lot of people with how strong AI-related growth has become. What used to feel like an NVIDIA-only story is now spreading across the entire semiconductor ecosystem, and that is exactly why Tom Lee believes the rally still has legs. One of the strongest points he makes in this interview is when he talks about semiconductor valuations. He says the forward PE ratio for the semiconductor index is around 22 times earnings. Now, for some investors, that may sound expensive, but Tom Lee argues that historically speaking, semiconductors have traded much higher than that during previous technology booms. He says the sector reached as high as 35 times earnings over the last 20 years. What he is basically saying is this: even after this massive AI run, these stocks may not actually be as overpriced as people think. And personally, I think that is one of the biggest misconceptions in this market right now. A stock can look expensive on the surface after a huge rally, but if earnings are growing fast enough, the valuation may still be reasonable relative to future growth. That is the core of the AI bull thesis right now. The market is betting that AI-driven productivity growth will dramatically increase corporate earnings over the next several years. If that happens, today's valuations may eventually look cheap in hindsight. Another interesting part of this interview is when Tom Lee talks about skepticism still being present in the market. He says there is still a lot of money sitting on the sidelines, especially from retail investors who missed part of the rally and are now chasing performance. That is a very important observation because bull markets often continue longer than expected when there is still skepticism in the system. A true market top usually happens when everybody is fully invested and convinced stocks can only go higher. But according to Tom Lee, we are not fully there yet. He believes there is still hesitation, caution, and disbelief from many investors, which, ironically, can keep fueling the rally as more money slowly comes back into the market. At the same time, though, I do think there is an argument that parts of this market are becoming overheated. Some AI stocks are moving almost vertically. Certain companies are getting massive valuations based more on future expectations than current profits. So while I understand Tom Lee's optimism, I also think investors need to separate high-quality AI leaders from speculative momentum plays that are just riding the hype wave. The interviewer then brings up Ed Yardeni's Buzz Lightyear theory of AI going to infinity and beyond, and honestly, that perfectly captures the mood surrounding artificial intelligence right now. There is a growing belief on Wall Street that AI could fundamentally reshape the economy in the same way the internet did decades ago. Tom Lee takes that idea seriously. He says AI could potentially add 2 percentage points to GDP growth every year for the next 5 years. That is a massive statement. If true, it would completely reshape earnings expectations across corporate America. Think about what that means for a second. 2 extra percentage points of GDP growth annually is enormous for a developed economy like the United States. That kind of productivity acceleration could create a powerful environment for stocks, especially if inflation stays relatively controlled. Tom Lee then connects that directly to S&P earnings growth. He estimates AI productivity could contribute roughly 6% earnings growth for the index. And honestly, this is where his thesis becomes very compelling. Because what the market really cares about is not just innovation itself, it cares about earnings growth. If AI materially increases profits across industries, then the higher stock prices start becoming easier to justify. What also stood out to me is how he frames AI as creating growth without necessarily causing inflation. That is a dream scenario for Wall Street. Historically, strong economic growth often leads to inflation pressure, which then forces the Federal Reserve to tighten monetary policy aggressively. But Tom Lee is suggesting AI productivity gains may increase output and efficiency enough to boost growth while helping keep inflation contained. If that actually happens, it could become one of the most bullish macro environments we have seen in years. But what I like about this interview is that Tom Lee is not blindly bullish either. He still warns that turbulence is likely later this year. That is a critical part many people may overlook. The interviewer reminds viewers that Tom Lee originally expected the market to rally strongly, then experience a meaningful pullback before pushing even higher later. And despite the market's resilience so far, Tom Lee says he still believes a 15 to 20% drawdown could happen. That is a huge statement because it shows he is not saying the market will move straight up forever. He still sees major risks ahead. The first risk he points to is the Federal Reserve. He mentions that the market will eventually have to test the views of the incoming Fed leadership. Basically, he believes there could be uncertainty surrounding how future policymakers interpret inflation and react to economic conditions. And honestly, the market is incredibly sensitive to Fed policy right now. Even small changes in interest rate expectations can trigger major volatility in high-growth sectors like technology and AI. So if investors begin worrying that the Fed may stay tighter for longer, that could absolutely create a sharp correction. The second risk he talks about is energy and petroleum shortages connected to geopolitical tensions and shipping disruptions. He warns that if oil prices spike later in the year, it could create another major stress point for the market. This part of the interview is actually very important because it reminds viewers that even in an AI-driven bull market, macroeconomic realities still matter. Energy prices affect inflation, inflation affects interest rates, and interest rates affect stock valuations. So while AI may be the dominant narrative right now, the broader economy still has the power to disrupt markets very quickly. What I personally find most interesting about Tom Lee's overall message is that he seems to believe we are entering a completely new economic cycle driven by AI scarcity. He repeatedly talks about scarcity throughout the interview. Scarcity of compute power, scarcity of semiconductors, scarcity of energy infrastructure, and historically, scarcity creates pricing power and huge profit opportunities for the companies controlling those bottlenecks. That is why companies building the picks and shovels of the AI revolution continue attracting so much investor attention. The market is not just rewarding flashy AI applications, it is rewarding the infrastructure providers enabling the entire ecosystem. At the end of the interview, Tom Lee basically summarizes his thesis this way. Yes, there could absolutely be volatility ahead. Yes, there may eventually be a painful correction, but the long-term structural AI story is still powerful enough to keep pushing markets higher over time. And honestly, whether you fully agree with Tom Lee or not, one thing is becoming impossible to ignore. Artificial intelligence is no longer just a speculative theme, it is now directly influencing corporate spending, earnings growth, market leadership, and even macroeconomic forecasts. The big question now is whether this AI boom becomes another temporary market mania or the beginning of a generational economic transformation similar to the internet revolution. And that is exactly why investors need to pay attention to what is happening underneath the surface of this market right now. Now let's dive in and talk about the specific AI stocks and sectors that could benefit the most from everything Tom Lee is describing. These are 3 solid tech stocks that could quietly become major long-term winners as artificial intelligence transforms the global economy. The first company on this list is Analog Devices, ticker symbol ADI. Analog Devices is one of the most important semiconductor companies that many retail investors still do not fully understand. And honestly, that may be exactly why the stock still deserves serious attention right now. This is not a trendy consumer technology company trying to capture attention with flashy headlines. Analog Devices operates in one of the most critical and specialized areas of the semiconductor industry. the company designs analog, mixed signal, and digital signal processing semiconductors that allow electronic systems to interact with the physical world. That may sound technical, but the real-world importance of this business is massive. Every time a machine measures temperature, pressure, motion, sound, light, or power, analog chips help convert those real-world signals into digital data that computers and intelligent systems can process. Without analog semiconductors, modern technology infrastructure would not function properly. That means analog devices sits directly at the center of several major long-term growth trends, including industrial automation, electric vehicles, advanced manufacturing, aerospace systems, renewable energy infrastructure, healthcare technology, telecommunication systems, and increasingly artificial intelligence. And this is where the story becomes especially interesting. Most people associate artificial intelligence with giant cloud data centers and advanced graphics processors. But over the next decade, AI will increasingly move into edge computing, where intelligent processing happens directly inside machines, industrial systems, vehicles, and connected devices instead of relying entirely on centralized cloud systems. That transition creates a major opportunity for analog devices. Because as more systems become intelligent, they require more sensors, more signal processing capabilities, more efficient power management systems, and more precision electronics. Analog Devices specializes in exactly those technologies. This is one reason why the company could quietly benefit from the AI revolution in ways many investors may still be underestimating. Another thing that makes Analog Devices so attractive is the company's competitive moat. Many of the products supplied by Analog Devices are deeply integrated into mission-critical industrial and automotive systems. Once a company designs Analog Devices chips into its hardware platforms, switching suppliers can become extremely difficult and expensive. Imagine an automotive manufacturer redesigning complex electronic systems inside modern vehicles just to change chip suppliers. That process can take years, require enormous engineering resources, and introduce major reliability risks. As a result, customers often stay with trusted semiconductor suppliers for very long periods of time. That creates durable customer relationships and strong pricing power for Analog Devices. And honestly, this is one of the most underrated aspects of the semiconductor industry. Not all chip companies compete in the same way. Some businesses face brutal competition and rapid product replacement cycles, but analog semiconductor businesses often operate with longer product cycles and more stable customer relationships. That stability matters for investors. The company also benefits from broad diversification across industries. Analog Devices serves industrial markets, automotive customers, communications infrastructure providers, healthcare technology systems, and aerospace applications. This reduces dependence on any single customer category or economic sector. So even when one market slows temporarily, other segments can help stabilize overall business performance. Now let's talk about one of the biggest long-term opportunities for Analog Devices, and that is industrial automation. Around the world, businesses are racing to modernize factories using robotics, intelligent sensors, predictive maintenance systems, automation technologies, and AI-enhanced manufacturing processes. Companies want greater efficiency, lower operating costs, improved energy management, higher production precision, and better long-term productivity. Analog Devices products help make those systems possible. This is one reason why I personally believe industrial automation could become one of the most underappreciated AI investment themes of the next decade. Everyone talks about AI chatbots and software applications, but underneath the surface there is a massive physical transformation happening across factories, logistics systems, energy infrastructure, and industrial equipment, and semiconductors are at the center of that transformation. The automotive market is another major growth driver. Modern vehicles are becoming increasingly sophisticated electronic systems packed with advanced driver assistance features, battery management systems, radar technologies, connectivity systems, and intelligent safety features. Electric vehicles especially require significantly more semiconductor content than traditional gasoline-powered vehicles, and Analog Devices supplies technologies into many of those critical systems. As vehicle technology becomes more advanced, semiconductor demand per vehicle continues rising. That creates another powerful long-term growth opportunity for the company. Financially, Analog Devices continues showing strong momentum. Global semiconductor sales have been rising sharply due to increasing AI demand and broader technology adoption across industrial and automotive markets. Industry data recently showed semiconductor sales reaching nearly $89 billion in a single month, highlighting the enormous scale of demand growth occurring throughout the semiconductor ecosystem. Analog Devices has also benefited from improving earnings expectations. Analysts have projected strong earnings growth for the company, with estimates increasing as demand trends remain healthy across key end markets. And honestly, rising earnings estimates are something investors should always pay attention to because over the long run, stock prices tend to follow earnings growth. Another thing I really like about Analog Devices is management discipline. This is not a company recklessly chasing every new trend just to generate excitement. Management has historically focused on operational efficiency, profitability, free cash flow generation, and long-term shareholder value creation. That matters, because strong free cash flow gives companies flexibility. It allows them to continue investing in research and development, pursue strategic acquisitions, repurchase shares, strengthen manufacturing capabilities, and return capital to shareholders through dividends. Analog Devices has built a strong reputation as a reliable dividend growth company within the semiconductor industry, which is especially attractive for long-term investors looking for both growth and income potential. And I think this combination is extremely powerful. You are getting exposure to long-term AI and industrial technology growth while also owning a profitable business already generating meaningful cash flow today. Many speculative AI companies are still years away from producing substantial profits. Analog Devices already has an established business model with strong margins and durable customer demand. That creates a much more balanced investment profile. Valuation is another important point here. A lot of investors assume every semiconductor stock connected to AI has become dangerously overvalued. But companies like Analog Devices still trade at far more reasonable valuations compared to many speculative AI names dominating headlines right now. And that creates an interesting opportunity. Because if AI adoption continues expanding across industrial systems, automotive technologies, smart infrastructure, and connected devices, Analog Devices could continue benefiting from long-term demand growth without requiring unrealistic assumptions to justify its stock price. The communications infrastructure business also remains important. As global data usage grows and network infrastructure becomes more advanced, demand for high-performance analog and signal processing technologies continues increasing. Analog Devices supplies products used throughout communication systems that help support modern connectivity infrastructure. Healthcare technology is another interesting area. Medical systems increasingly rely on precision sensing, imaging technologies, monitoring equipment, and intelligent diagnostics. Analog Devices products support many of those advanced healthcare applications. And honestly, this broad exposure across multiple high-growth industries gives the company a level of diversification many technology businesses simply do not have. Another thing worth mentioning is geopolitical resilience. Governments around the world are increasingly focused on semiconductor supply chain security and domestic technology infrastructure. Companies with diversified customer bases and deep industrial relationships may be better positioned to navigate geopolitical uncertainty over the long term. Analog Devices benefits from serving multiple industries across multiple regions, reducing dependence on any single market. Now, of course, no investment is risk-free. The semiconductor industry remains cyclical. Economic slowdowns can temporarily impact industrial spending and automotive production. Supply chain disruptions can create volatility, and broader market sell-offs can still pressure semiconductor stocks even when long-term fundamentals remain strong. But when you step back and look at the bigger picture, Analog Devices appears positioned directly at the intersection of several powerful secular growth trends: artificial intelligence, industrial automation, electric vehicles, smart infrastructure, advanced manufacturing, connected systems, and intelligent edge computing. And unlike many speculative growth stories, this company already generates significant profits, strong cash flow, and durable customer relationships today. That combination of long-term relevance, competitive advantages, financial strength, and exposure to critical future technologies is exactly why Analog Devices deserves serious consideration from long-term investors looking for high-quality semiconductor exposure. Because sometimes the best technology investments are not the companies getting the loudest headlines. Sometimes they are the businesses quietly supplying the foundational technologies the future depends on. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second company on this list is Texas Instruments, ticker symbol TXN. Texas Instruments is one of the oldest semiconductor companies in the world, but what makes this business so fascinating is how relevant and dominant it still remains in today's rapidly changing technology landscape. A lot of investors hear the name Texas Instruments and immediately think about calculators from school classrooms years ago, but the reality is that this company has evolved into one of the most important analog semiconductor businesses powering modern industrial infrastructure, automotive systems, factory automation, communications equipment, medical devices, and intelligent electronics all over the world. And honestly, Texas Instruments may be one of the most overlooked long-term AI beneficiaries in the semiconductor industry. Because while most investors focus entirely on advanced AI processors and data center chips, the AI revolution also requires massive growth in analog semiconductors, embedded processing systems, power management technologies, and sensing infrastructure. And Texas Instruments specializes in exactly those categories. One thing investors need to understand is that not every important semiconductor is the flashy high-performance processor grabbing headlines on financial television every day. Many of the most essential chips inside modern systems are simpler, analog and embedded semiconductors responsible for managing power, controlling signals, monitoring sensors, processing communications, and coordinating system functions. Without those chips, modern electronic systems would not operate efficiently or reliably. Texas Instruments has spent decades building deep expertise in these markets, and that expertise has created one of the strongest competitive positions in the semiconductor industry. The company operates across tens of thousands of products and serves a massive customer base spanning industrial markets, automotive companies, communications infrastructure providers, healthcare systems, aerospace applications, and consumer electronics manufacturers. That diversification matters a lot because it reduces the company's dependence on any single customer or market segment. Even when one industry slows temporarily, other segments can help stabilize the business. This is one reason why Texas Instruments has historically been viewed as one of the more resilient semiconductor companies during volatile market environments. Another major advantage is manufacturing. Unlike some semiconductor companies that rely heavily on third-party manufacturing partners, Texas Instruments produces a large portion of its own chips internally. That gives the company greater control over supply chains, production efficiency, manufacturing quality, and operating margins. And in today's environment, manufacturing control has become incredibly important. Recent semiconductor shortages showed the world just how critical chip supply chains really are. Companies with internal manufacturing capabilities often have greater flexibility and resilience during periods of supply disruption. Texas Instruments has also been investing aggressively in expanding semiconductor manufacturing capacity inside the United States. That could become an even bigger advantage moving forward as governments increasingly prioritize domestic semiconductor production and supply chain security. Now let's talk about why Texas Instruments could become a major long-term winner from the expansion of artificial intelligence. The AI story is evolving beyond massive cloud data centers. Over time, AI processing will increasingly move toward edge computing, where intelligent systems operate directly inside machines, factories, vehicles, industrial equipment, medical systems, and connected devices. And every one of those systems requires analog semiconductors and embedded processing technologies. You need chips managing power efficiently. You need chips monitoring sensors. You need embedded processors coordinating system operations. You need connectivity systems enabling machine-to-machine communication. You need intelligent power conversion systems supporting advanced electronics. Texas Instruments products are deeply embedded throughout those ecosystems. And this is why I think many investors are still underestimating the company's long-term positioning. The future economy will become dramatically more automated, connected, and intelligent. Factories will become smarter. Infrastructure systems will become smarter. Energy grids will become smarter. Transportation systems will become smarter. Industrial equipment will become smarter. And all of those transitions require exactly the types of semiconductors Texas Instruments produces. Industrial automation is one of the biggest opportunities here. Around the world, companies are investing billions of dollars into robotics, predictive maintenance systems, AI-enhanced manufacturing, industrial Internet of Things technologies, and intelligent production systems. Businesses want greater productivity and efficiency while reducing operational costs and improving system reliability. Texas Instruments products help enable those transformations. And unlike some short-cycle consumer technology trends, industrial modernization often unfolds over many years or even decades. That creates durable demand opportunities for semiconductor suppliers serving those industries. The automotive market is another enormous growth driver for Texas Instruments. Modern vehicles contain dramatically more semiconductor content than previous generations of vehicles. Electric vehicles especially require advanced battery management systems, power conversion technologies, intelligent safety systems, radar sensors, infotainment platforms, and connectivity infrastructure. Texas Instruments supplies chips into many of these applications, and as automotive technology becomes more advanced, semiconductor demand per vehicle keeps increasing. This trend alone could support long-term revenue growth across the automotive semiconductor market for years. One thing I personally find especially attractive about Texas Instruments is management discipline. This is not a company chasing hype or making reckless acquisitions simply to generate excitement. Management has historically focused on operational efficiency, long-term capital allocation, profitability, and shareholder returns. That approach has allowed the company to generate substantial free cash flow consistently over time, and free cash flow matters enormously for investors. Strong free cash flow gives businesses flexibility during uncertain economic environments. It allows companies to continue investing in research and development, expand manufacturing capacity, repurchase shares, pay dividends, and strengthen their competitive position even during industry downturns. Texas Instruments has also built one of the strongest dividend growth track records in the technology sector, and honestly, I think many investors underestimate how powerful dividend compounding can become over long periods of time, especially when combined with exposure to durable technology growth trends like automation, electrification, and artificial intelligence. This combination of growth and shareholder returns creates a very balanced investment profile. You are not simply betting on speculative future possibilities. You are owning a profitable business already generating meaningful cash flow today while participating in long-term technology expansion. Another important factor supporting Texas Instruments is the company's long product lifecycle model. Unlike cutting-edge processors that may become obsolete quickly, many analog semiconductors remain in use for long periods across industrial and automotive systems. That means customers often continue purchasing the same products for years. This creates stable recurring demand and improves returns on manufacturing investments over time. And this is one of the hidden strengths of analog semiconductor businesses. They may not always generate the same level of media attention as high-performance computing companies, but they often produce highly durable business models with strong margins and stable customer relationships. Financially, Texas Instruments continues benefiting from healthy semiconductor demand trends tied to industrial and automotive markets. Global semiconductor sales have remained strong due to expanding AI infrastructure, industrial modernization, and increasing electronic content across multiple industries. Analysts also continue viewing Texas Instruments as a well-positioned beneficiary of long-term semiconductor growth trends. Valuation is another important consideration. A lot of speculative AI-related stocks are trading at extremely aggressive valuations based almost entirely on future expectations. Texas Instruments often trades at more balanced valuation levels relative to many of those higher-flying technology names. That could provide investors with a more attractive long-term risk-reward setup, because if semiconductor demand continues expanding steadily across industrial automation, automotive technologies, connected infrastructure, and edge AI systems, Texas Instruments may continue compounding value without requiring unrealistic assumptions. And honestly, I think there is a strong argument that consistency eventually wins over hype in long-term investing. Businesses with durable margins, strong cash flow generation, diversified customer bases, and disciplined management teams often become exceptional compounders over time. Texas Instruments fits that description extremely well. Another major trend benefiting the company is electrification. As industries shift toward electric systems, renewable energy technologies, electric transportation, and more energy-efficient infrastructure, demand for advanced power management semiconductors continues growing. Texas Instruments products play an important role in enabling those systems. Energy efficiency itself is becoming increasingly important globally. Whether it is data centers, vehicles, industrial systems, or consumer electronics, managing power efficiently has become a critical engineering challenge. And Texas Instruments has extensive expertise in power management technologies. Healthcare technology is another interesting growth area. Modern medical equipment relies heavily on analog semiconductors, sensing technologies, imaging systems, and embedded processing capabilities. Texas Instruments products support many advanced healthcare applications that require precision, reliability, and long product support cycles. This broad industry exposure creates another layer of resilience for the business. Now, of course, there are still risks investors need to consider. Industrial demand can weaken during economic slowdowns. Automotive production cycles can fluctuate. Semiconductor inventory corrections can create temporary pressure. And broader market volatility can impact even high-quality technology stocks. But when you zoom out and focus on the long-term picture, the fundamental trends supporting Texas Instruments still appear extremely compelling. The world is becoming more connected, more intelligent, more automated, more electrified, and more dependent on semiconductors across nearly every industry. Texas Instruments sits directly at the center of those transformations, and that is exactly why this company deserves serious attention from long-term investors looking for stable exposure to the future growth of semiconductors and artificial intelligence. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third company on this list is NXP Semiconductors, ticker symbol NXPI. NXP Semiconductors may not receive the same level of mainstream attention as some larger technology companies, but this business has quietly built one of the strongest positions in several extremely important growth markets that could expand significantly over the next decade. And honestly, when you really start digging into what this company does, you begin to realize that NXP is deeply embedded into the future of intelligent transportation, connected infrastructure, industrial automation, and edge computing. This is not a speculative company hoping AI eventually changes its business. NXP is already supplying critical semiconductor technologies that modern intelligent systems rely on today. The company specializes in high-performance mixed-signal semiconductors used across automotive systems, industrial equipment, secure connectivity infrastructure, Internet of Things technologies, communication systems, and embedded processing applications. But what really makes NXP stand out is its dominance within the automotive semiconductor market. Modern vehicles are rapidly transforming from mechanical machines into highly advanced computing platforms. Today's vehicles contain sophisticated driver assistance systems, radar sensors, cameras, battery management technologies, infotainment systems, secure connectivity features, advanced networking architectures, and intelligent safety technologies, and NXP supplies semiconductors into many of those critical systems. This matters because the automotive industry is currently undergoing one of the biggest technological transformations in its history. Electric vehicles continue expanding globally. Advanced driver assistance systems are becoming more common, vehicles are becoming increasingly connected, and autonomous driving technologies continue evolving rapidly. Every one of those trends increases semiconductor content inside vehicles. That creates a powerful long-term demand opportunity for companies like NXP. One thing many investors underestimate is how sticky automotive semiconductor relationships can become. Automotive companies prioritize reliability, long-term engineering support, safety certification, and trusted supplier relationships. Once semiconductor suppliers become integrated into complex vehicle architectures, switching providers can become extremely expensive and time-consuming. That creates a strong competitive moat for NXP. And honestly, this is one reason why the company has managed to maintain such an important position in the automotive semiconductor ecosystem. Another thing that makes NXP particularly attractive right now is the company's exposure to edge computing and intelligent connected systems. The AI revolution is not going to remain limited to giant cloud data centers forever. Over time, intelligence will increasingly move directly into devices themselves. Vehicles will process more information locally. Factories will become more autonomous. Industrial systems will become smarter. Connected infrastructure will make more real-time decisions. And Internet of Things devices will require more embedded intelligence and secure connectivity. NXP is positioned directly inside those trends. The company provides semiconductors enabling communication, sensing, embedded processing, networking, and secure data transmission across intelligent systems. This creates multiple long-term growth opportunities simultaneously. One area where NXP has built a particularly strong position is secure connectivity technologies. As more systems become connected, cybersecurity and secure communication become increasingly important. Whether it is automotive systems, payment technologies, industrial infrastructure, or connected devices, secure identification and communication capabilities are becoming essential requirements. NXP has extensive expertise in secure identification technologies, near-field communication systems, and embedded security solutions. And honestly, I think this could become an even more valuable competitive advantage over time. Because as the world becomes more connected, protecting data and securing communications will become increasingly critical across nearly every industry. Industrial automation is another major growth driver for NXP. Around the world, companies are investing heavily in intelligent manufacturing systems, robotics, predictive maintenance technologies, connected industrial equipment, and AI-enhanced production systems. Businesses want greater efficiency, lower operating costs, better precision, and improved system reliability. NXP products support many of those technologies. And this is another reason why I believe the market may still be underestimating the broader semiconductor opportunity tied to industrial modernization. Most people focus almost entirely on AI software applications and cloud computing infrastructure, but underneath the surface, there is a massive physical transformation happening across factories, transportation systems, logistics infrastructure, and industrial operations globally, and semiconductors are the foundation enabling all of it. NXP also benefits from growing demand for energy-efficient systems. As electronic systems become more advanced, managing power consumption efficiently becomes increasingly important. Whether it is electric vehicles, industrial machinery, smart infrastructure, or connected devices, companies need semiconductors capable of improving performance while reducing energy usage. NXP has strong positioning across power management and system efficiency technologies. Financially, the company continues showing solid growth potential. Analysts have projected earnings growth around 18% for the current year, supported by healthy demand trends across automotive and industrial markets. Earnings estimates have also improved recently, which often reflects growing confidence in future business performance, and honestly, rising earnings expectations are one of the most important indicators investors should watch because long-term stock performance is heavily driven by earnings growth. Another thing I personally like about NXP is the company's balance between growth exposure and operational discipline. This is not a company recklessly chasing speculative opportunities. Management has historically focused on profitability, margin stability, operational execution, and long-term shareholder returns. That discipline matters, because the semiconductor industry can still experience volatility and cyclical downturns. Companies with strong margins and disciplined financial management are often much better positioned to navigate difficult periods while continuing to invest for long-term growth. NXP has also returned substantial capital to shareholders through share repurchases and dividends over time. That combination of long-term technology exposure and shareholder returns creates a much more balanced investment profile for long-term investors. Another major catalyst for NXP is infrastructure modernization. Governments and businesses around the world are investing heavily in smarter transportation systems, connected infrastructure, intelligent industrial systems, digital security technologies, and advanced communications networks. All of those transitions require increasingly sophisticated semiconductor solutions. NXP products help support many of those systems. And honestly, I think this broader infrastructure transformation story is still not receiving enough attention from the market. Because while everyone is focused on AI software headlines, there is also an enormous hardware and infrastructure build-out happening globally. Transportation systems are becoming smarter, industrial facilities are becoming more automated, cities are becoming more connected, energy systems are becoming more intelligent, and semiconductors sit directly at the center of those transitions. Another thing investors should appreciate about NXP is diversification. The company generates revenue across automotive markets, industrial systems, communications infrastructure, mobile technologies, and connected devices. That diversification helps reduce dependence on any single industry or customer category. It also creates more resilience during economic uncertainty. Now, of course, no stock is without risk. Automotive demand can weaken during economic slowdowns. Industrial spending cycles can fluctuate. Semiconductor inventory corrections can pressure margins temporarily, and geopolitical tensions can create uncertainty across global supply chains. But when you zoom out and look at the bigger picture, the long-term trends supporting NXP still appear extremely powerful. Artificial intelligence, connected infrastructure, industrial automation, electric vehicles, advanced transportation systems, secure digital communication, and intelligent edge computing. All of these trends require semiconductors. And not just the high-profile AI processors dominating headlines every day. The world also needs the automotive, analog, industrial, sensing, connectivity, and embedded semiconductors supplied by companies like NXP. And honestly, I think that is one of the most important takeaways from this entire video. Many investors are so focused on chasing the obvious AI stocks that they may be overlooking the foundational semiconductor companies quietly enabling the broader technological transformation happening across the global economy. Now, when you step back and look across all three companies we discussed today, a very important pattern starts to emerge. Analog Devices supplies critical analog and signal processing technologies powering intelligent systems and industrial automation. Texas Instruments dominates essential analog and embedded semiconductors used across industrial infrastructure, automotive systems, healthcare technologies, and connected electronics. NXP Semiconductors helps power intelligent transportation, secure connectivity, industrial automation, and edge computing infrastructure, and all three companies benefit from the same powerful secular trends shaping the future economy: artificial intelligence, industrial modernization, electrification, connected infrastructure, automation, edge computing, and rising semiconductor demand across nearly every major industry. What makes these businesses especially attractive is that they are not speculative startups relying entirely on future projections. These are already profitable companies with durable customer relationships, strong competitive positions, meaningful free cash flow generation, and exposure to multiple long-term growth opportunities. And honestly, sometimes the best investment opportunities are not the companies making the loudest headlines. Sometimes they are the businesses quietly supplying the technologies the world increasingly depends on. Now I want to hear from you. Which of these three semiconductor companies do you believe has the strongest long-term advantage as artificial intelligence, automation, and connected technologies continue expanding globally? Do you think Analog Devices, Texas Instruments, or NXP Semiconductors has the best combination of growth potential, competitive moat, and long-term durability? Let me know your thoughts in the comments below. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.